First RMD, how to avoid a massive tax hit. That first RMD notice means the IRS is done waiting, and if you handle the timing wrong, you could end up paying taxes on 2 full RMDs in a single year instead of 1. By the end of this video, you'll know 3 moves that keep your first required minimum distribution from blowing up your tax bracket and your Medicare premiums. Here's the short answer. Your first RMD is due by April 1st of the year after you turn 73. But delaying to that deadline means that you'll owe 2 RMDs in the same calendar year. And that can shove you into a higher tax bracket and trigger Medicare surcharges 2 years down the road. So the real question isn't just, how much do I owe? It's when do I take it and what do I pair it with? Most people hear April 1st deadline and think they're getting a bonus year. Technically, yes, but here's what that actually costs you. Say your first RMD is around $45,000, just to keep the math clean. If you wait until March of the following year to take it, your second RMD for that current year is still due by December 31st. That's roughly $90,000 of added income on one tax return. If you were sitting comfortably in the 22% bracket, that extra $45,000 could push part of your income into 24% or higher, and that's just federal. The fix is straightforward. Take your first RMD in the calendar year it actually applies to, not the grace period year. You spread the income across 2 tax returns instead of piling it into one. If you're donating to charity anyway, a qualified charitable distribution lets you send money directly from your IRA to a qualified charity. That transfer counts toward your RMD, but it never shows up as taxable income on your return, which basically means you check the IRS box without adding a single dollar to your adjusted gross income. And AGI is the number that drives your tax bracket, your Medicare premiums, and how much of your Social Security gets taxed. One number, 3 consequences. 2 rules to know. You have to be 70 and a half or older, and the money has to go straight from the IRA custodian to the charity. It can't pass through your bank account first, not even for a single day. Here's what blindsides people. Medicare looks at your income from 2 years ago to set your premiums today. A big RMD in 2026 can mean higher Part B and Part D premiums in 2028. The surcharges aren't trivial. Depending on where your income lands, you and your spouse could each pay several $100s more per month, and that compounds across every year you're above the threshold. This is exactly where RMD planning stops being just a tax question. It is a tax question, a Medicare question, and, if you're charitably inclined, a giving strategy question, all running on the same income number. When those pieces aren't coordinated, one smart decision in isolation can quietly create a problem somewhere else. An unfunded plan is like putting a "Beware of dog" sign in your yard without actually owning a dog. It looks right until someone checks. Quick recap. Take your first RMD in the year it applies, not the grace period year. Use a QCD if you're giving to charity anyway, and check what your RMD does to your Medicare premiums 2 years from now. If you're staring at the first notice and the math feels bigger than you expected, it might be worth getting a second set of eyes on how your taxes, Medicare, and giving strategy all fit together. There's a link in the description if you'd like to start that conversation.